Okay, so today I wanted to do a case study on choosing the right insurance plan for you. So let's look at this case study where it is we have a 25-year-old healthy female. She has a daughter, 1 year old, and her monthly salary is $6,000 a month. Now Anita has a budget for insurance between $500 to $600 monthly. So my role as an insurance advisor is to help bring value to you and help give you the information that you need so that you are able to make an informed decision. Now, with that being said, Anita and I would have had a conversation in terms of how she wants to benefit from the insurance, how she wants the insurance to work for her. Now, the main point is that Anita's interest in the insurance is that she wants to ensure that her daughter is taken care of if anything was to happen to her. That is the driving force in Anita reaching out to me to have the conversation about insurance. Now, a key point to note, when Anita reached out to me as well, her first and only interest was in the endowment life insurance, right? Now, I did a lot of videos on the endowment and how it works. So here's a breakdown in terms of the two options based on our discussion. Wanted to have a quote in terms of how the endowment plan will work for. So just to give an idea, let's say this was option A. Option A is a $500K life insurance endowment to age 60, right? Now what this will mean is that if Anita passes away before age 60, her daughter will receive the $500K, but if Anita lives to age 60, she will receive the $500K. So the monthly contribution for this was $561. Now remember, Anita's budget was between $500 to $600. So if it is we was to go with option A, it basically means that we allocate the full budget towards the endowment. So this was the first option, but what I wanted to do is to give a second option. So this was option B. So here's what option B looked like. What we did is that we did $1 million term insurance to age 65. We did a $500,000 critical illness insurance that covers 21 different critical illnesses, and also we did a $200 savings monthly that she can access at any time. Her total monthly contributions was $575 for these three things. Now, what does this mean? This means that if Anita passes away before age 65, her daughter will receive $1 million. It also means that if Anita is diagnosed with a critical illness, she will receive $500,000 as a living benefit. But Anita is also saving $200 every month from this $575 that's going towards her insurance. Now, based on the two options, Anita decided to go with option B. Now, the reason for that is Anita initially wanted the endowment, but she decided to go with option B because she rather her daughter gets $1 million if she passes away instead of $500,000. Remember, the endowment was only $500,000. But also, because cancer runs in her family, she saw value in having a critical illness insurance one time. Now, does that mean that if she had choose option A is the bad option? No. Anita was able to make an informed decision in terms of we discussed the pros and the cons of the two options, and she decided to go with option B. So she saw value in option B. If she had choose option A, that would have been fine, and we could have added on the critical illness later on and increase. That would have been fine as well. But for now, Anita wants to get the most amount of coverage based on her current budget. But what I would have told Anita is that what we can do in the future, Anita can convert her term insurance into an endowment insurance. I did a video on it at any time once her budget increases. But based on her current budget, as I said, she wanted to get as much coverage as she can get to make sure that her daughter is taken care of. If you guys saw value in this and would like to get more information, click the link in my bio or contact me via the number below, which is 475-0495.